In today's video, we're going to take some time to discuss one of the most important parts of the investing process, that specifically being managing your emotions and investor behavior. We're going to go through today some points that will give you a plan of action to help you in volatile times and to hopefully increase your odds of long-term investing success by giving you key areas of your emotional behavior that you can focus on. So the key areas that we're going to focus on today to give you a plan of action for managing volatility would be looking at and discussing how emotions will drive most of your behavior, the rules that we set up to manage that behavior through your investment policy statement, the importance of adhering to and developing your asset allocation strategy, something we call the cash wedge strategy for managing variability. And finally, we'll go through some examples of the various portfolios we use at Luft Financial once you've set up that asset allocation and investment policy statement. Before you even look at investing any of your money, it's really important to consider the time horizon and what the money's for. So I'll often get clients ask me the question, I've got X amount of money, I want to invest it, what should I do with it? And I'll say, I have no idea. And they'll look at me funny because they know we manage a considerable amount of money for people, and how come I don't have an answer as their coach? What I want you to consider is the time horizon and the goal for the money is the most important thing. If you truly are an investor, you need to think about putting away money for a period of time where you do not need that capital back. So if you think about things like pension plans, real estate, and a true portfolio for an investor, you're putting and investing your capital into something where you do not require all of that capital back for an extended period of time. Extended meaning at least 3 years. It doesn't mean it's illiquid, it means you don't need the capital. But if you need that capital back within the next 36 months, you want no variability on the capital, no potential chance for loss of that capital. Regardless of whether or not that keeps up with inflation, you're talking about cash, and you're not really an investor at that point. You're saving. So right now, you can use things like a GIC, a term deposit, etc. But that's what cash is for, cash or cash-like investments. No risk, no long-term return after tax and inflation. Use this for spending, for lifestyle, lump sum purchases, travel. So we have to differentiate, first of all, what the dollar is for. So if I need the whole dollar back within the next 3 years, I'm a saver. If I can allocate that capital for growth and income and sustain some variability over time, that's where I'm an investor.